Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bonson's Capital Record, brought to you by National Review. We are going to sort of take a little break from the last couple episodes' theme of the tariff talk, although not really. This topic is inspired by the kind of moment in which we find ourselves of trade war and tariff talk and economic protectionism coming from a Republican administration with an awful lot of support from a Republican voting base. And I've had plenty to say already about what I think is the lay of the land in this tariff talk discussion and problem, and where the chaos of it I think is unhelpful, and where the understanding about trade deficits is so flawed and incomplete that it is poisoning the well in terms of our economic discourse. But out of that subject that I just got done saying I'm not going to be talking about today has come the issue I do want to talk about, which is a real elevated, both in the quantity and the magnitude, the force of this position that the stock market is not the real economy, that what we are doing in terms of asset holders is very different than what matters to workers or regular people or whatever the kind of adjacent terminology is. I think you generally get the idea. And as a investor in public markets, responsible for billions upon billions of dollars of capital invested in that space, I have, I think, a certain understanding of where there is indeed a difference between the stock market and the real economy, that I'm happy to clarify and even help validate some of the folks saying that. But then I think it's important that we do a little bit deeper philosophical clarification, because I don't believe that the line from Princess Bride, I don't think that word means what you think it means. I think there are people using this expression that means something very different than what it really means. And I want to get to the bottom of this today. It is not a semantics discussion. If it were, I wouldn't bring it up. I have like 53 topics I'm backed up on right now for Capital Record. I'm not looking for fodder. There's plenty to talk about. This to me is a table stakes conversation for the future of defending free enterprise in our country. This to me is the essence of what this podcast exists for. This is at the heart of the debate. And if it were just merely a market comment, an economic comment, that the stock market and the real economy are not the same thing, we wouldn't have any issue. First of all, the facts are that they're not the same thing, in so much as public equity markets are measuring something. They are measuring corporate profits along with public sentiment, investor sentiment, optimism or pessimism about a future outlook, combined with a measurement of current earnings and the expectation for future earnings discounted in the present. These things are tautologically what market prices are. Now, ultimately, longer term, the weighting of sentiment and profits becomes overwhelmingly focused on profits. The value of a company is a byproduct of its future earnings. The role in which sentiment affects stock prices is very heavy in the short term and very light in the long term. And so you, depending on one's timeline, you get a kind of alteration in the mix of what's affecting and impacting stock prices between sentiment and profits. But there is a real sense in which people are telling the truth when they say the market and the economy are not the same thing, because markets are forward looking. And I use this analogy because it's one of the seminal illustrations of my career, but there is infinite fodder to make this point, that stock prices are looking forward, and they are sometimes doing so in the midst of economic conditions that can be very difficult. So in March of 2009, the market had gotten pummeled. The S&P traded to 666, the Dow traded to, let's call it 6,000. And on March 9th, the market turned around. And of course, a lot of pieces of the economy were not even near turning around. Unemployment still at double digits nearly 2 years later at the end of 2010. Why did the stock market turn around so much in advance of the economy turning around? For the simple reason that markets had already accelerated in their pricing in of the bad news. They had then, because of poor sentiment, overdone the pricing. And then, because of forward looking, markets began to say, okay, there are better days yet ahead, and investors began paying for what they believed would be the case, not what had already been the case. This is not rocket science. It is not illogical. There can be mistakes. Markets can begin. What are markets, of course, but the sum total of trillions of transactions and many, many millions, if not hundreds of millions, of independent actors. So it's the sum total of a lot of weight and consideration and belief and prognostication and calculation. It is fallible, and sometimes the thinking may have been accurate, but the outcome is different because the circumstances change. That's what the word forward looking, that's what the expression means, that the future has a certain uncertainty to it by definition. But at the same time, it is different than the real economy, because at that moment in time, jobs may be struggling, wages may be struggling. There are a whole lot of different factors than just corporate profits in the future when we think about the real economy in the present. So you would think this is so obvious, and in fact, not even necessarily problematic, that we could just move on and not have to make this any kind of an issue. The problem is what people mean, and right now it's coming up in spades with this tariff talk. I got the great privilege of reading one particular know nothing on Twitter saying, I don't care a bit about the Dow. Fair enough. I hope it does go to zero. All I care about is jobs for working class people. All right, well, what's going on there is not so subtle. Marxian class divide, where capital is being pitted against labor. And when I make the comment that the way markets price the value of public equity, and that is not the same thing as current labor conditions or other various current present tense economic data, um, I am not pitting the two against each other. I'm describing the fact that they're different categories and they represent different sequences of time. That economic data is measuring what just was, and markets are attempting to forecast or discount what will be. So there are structural differences on what they're measuring and the timeline that they're measuring. They are not at odds with one another, though, as if there is this tension. What is best for market prices is future corporate profits. What is best for future corporate profits is absolutely going to entail more hiring and more wages and more economic growth and more opportunity and more adjacent industries. And by the way, more competition, which leads to more hiring and wages. So there is a pro-cyclicality in all of these things, even if they happen to represent two different scales, measuring two different sequences or time periods. Um, it is utterly irrational to pit capital against labor And yet that is exactly what this conversation is so often intended to do. I asked the person who doesn't care about the Dow and hopes it goes to zero, but because all they want is working class jobs, if they feel the people at Caterpillar would agree. Or the working class, Caterpillar being one of the 30 stocks in the Dow Jones Industrial Average. Do they think the people that use Caterpillar tractors and trailers and equipment would agree? Did the person who sent that by chance tweet it on their Apple iPhone? Would they agree as it pertains to Apple products? Um, would those people who fly on Boeing airplanes or use Johnson and Johnson baby shampoo for their kiddos or fill up their car with gas from a Chevron station or are right now listening to this podcast, getting ready to tweet using Wi-Fi from a server made by Cisco, wearing Nike tennis shoes? I can go on because there's only 30 companies in the Dow. The fact of the matter is that public equity is not the entire economy of the United States. It's not even close to the entire corporate economy, but it is a vital part of the economy. And when we talk about private equity or small business or family business, all of these things are using goods and services that intertwine with public equity. So while the market and the real economy are not the same thing, they are certainly positioned or centered around the same elements for our purposes. A concern for the human person, and a better quality of life that comes from production, that comes from goods and services, that comes from the usefulness that comes from building things that others have utility for. This entire dimension is captured in the corporate profits that markets are seeking to measure and anticipate and reward, and that the economy revolves around this generation of profits, this production of profits that comes from productive and useful activity. Why do we feel the need to pit the two things against each other? Are we really in a position right now where the only folks that care about tariffs are people who own stocks in the S&P 500 companies? It's categorically absurd. By far, the companies with the least exposure for existential risk, for potentially fatal risk, are Dow Jones companies. The balance sheets, the access to capital, the access to other resources, the ability to ride out a transitional change in global trade, all of those benefits exist primarily at the top part of the corporate economy, namely public equities of a mega capitalization. Dow Jones companies, S&P 500, Fortune 100 companies. Those companies that have the least ability to withstand the uncertainty, transition, capital expenditure change, wasted investment, increase in cost of goods sold, etc. The ones with the most vulnerability are by far those small business companies in the quote unquote real economy. So we are doing a very bad job in this moment and in this conversation of identifying who is supposed to be the good guy and the bad guy. In a non-class warfare, non-Marxian worldview, there need not be any bad guy in this dialogue other than a disinterested third party who is intervening in economic transactions so as to use power to pick winners and losers. But when it comes to various actors pursuing self-interest, producing goods and services towards a profit aim, there is absolutely alignment between the objectives of various large companies and smaller companies. Now, you could say that a lot of these large companies chose to outsource um, into foreign labor environments some of the work needed. Well, first of all, if one doesn't believe that small business has done that, then what exactly are we even talking about? It's been absolutely categorically done because of comparative advantages by small business to a point where the cost of unwinding it for reshoring is exponentially harder and almost impossible for small business, real economy companies than it is for the big companies. But in both cases, we could either go last week for a dialogue on the silliness of this topic or have a future conversation about why this reshoring conversation is just nowhere near as simplistic as people have said it is, let alone moralistic. However, when it comes to the discussion about who has skin in the game, the answer is everybody, not just asset holders, not just investors in public equity. Everybody is in the real economy. Wage earners, have consumers, people employed or owning small business, people employed or owners of big business. There is no class divide in this subject. All there is the attempt to use the human impulse for covetousness, the Marxian tendency at class warfare and class envy to create a divide. It is economically fallacious because it is morally fallacious. Stock market and real economy, two different things. Stock market and real economy aligned towards, in their most optimal senses, the pursuit of profits that comes from producing goods and services that drive labor, that drive wages, that drive hiring, that drive competition, that drive growth, that drive opportunity. Yes, 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 and yes. Thank you for listening to David Bonson's Capital Record.